Hello everyone and welcome back to our channel. Today we are diving into a hot topic, the recent changes to Canada's capital gain taxes. We have already talked about a lot in our previous videos, but in today's video we are going a bit detail of it. Whether you are dealing with cryptocurrencies, shares, real estate or selling property like cottage, understanding capital gain is crucial for managing your finances effectively. So let's get started. So what are capital gains? In simple terms, when you sell your assets for more than what you paid for. On the other hand, when you sell your asset for less than its purchase price, it will result in a capital loss. So in tax terminology, we have the formula how to calculate the capital gain. So capital gain means sales price minus purchase price, and in accounting we call sale price as proceed of disposition and purchase price as adjusted cost base. We have already covered some basic concepts of capital gain. So now it's time to get back to our main topic. As we know, we have some bigger changes applied to the capital gain. Number one, so if you sell your asset before June 25th, the inclusion rate will be 50%, which means only half of the capital gain is taxable. On the other hand, if you sell your asset after June 24th, the inclusion rate will be 66.67%, meaning 2/3 of the capital gains will become taxable. But hold on, there is a catch. Individuals can still reduce their inclusion rate back to 50% on the first $250,000 of their capital gains. And you can also see this reduction on the Schedule 3 form or T1 general form of your tax return. Now let's understand these capital gain changes better with our first example. Meet Mr. John, who is going to sell his Tesla shares. He is having proceed of disposition, means sales price of $400,000 and adjusted cost base or purchase price was $40,000. So after putting the values in the formula, we will be having capital gain of $360,000. Now let's see how the new changes will affect the taxable capital gain calculation. Imagine if John is selling his shares before June 24th, the inclusion rate will be 50%. Which will result into $180,000 of the taxable capital gains. And if John is lying into 35% of marginal tax rate bracket, that will lead him to paying $63,000 of the taxes on the capital gains. On the other hand, if he is selling his assets after June 24th, the inclusion rate will be 66.67%, which will lead us to the $240,000 of taxable capital gains. And this time he will be owing $84,000 of taxes on this capital gain, which is leading us to the conclusion that Mr. John would be paying an additional $21,000 of taxes if he decides to sell his assets after June 24th. So with this example, we already came to know that how these two inclusion rate will be making difference in terms of taxes. But if we are considering the same example, and now this time we are taking threshold $250,000 into the picture, and let's see how the calculation will be affected this time. On our capital gain of $360,000, on first $250,000, the capital gain tax rate will be 50%, which means we have taxable capital gain of $150,000, and on remaining approx $100,000, the inclusion rate will be 66.67%, which will be making our taxable capital gain to approx $73,000. So after adding both taxable capital gains, we have total taxable capital gain of $198,000 on this $360,000 of capital gain. And if we are considering John in the same marginal tax bracket of 35%, this time he will be owing $69,000 of taxes on the capital gain of $360,000. Which means even with this new rule, the reduction for first $250,000 will definitely help the individuals to limit the tax impact. Alright everyone, that's all for today's video, and if you found this video helpful, please follow Textron for more tax updates.